$6,300. That is JP Morgan's official year-end target for gold. Not a permabull on YouTube. Not a newsletter writer trying to sell you something. JP Morgan, one of the largest institutional banks on the planet. And when I show you the data behind that number, the specific combination of signals that is driving that call, I think you are going to understand why this is not a price prediction. It is a structural thesis, and the evidence for it is sitting in plain sight right now. Here is what makes this week genuinely unusual. Gold is currently trading at approximately $5,182 per ounce. The US dollar index, the DXY, is sitting at 99.1 to 99.4. The 10-year Treasury yield is at 4.15 to 4.17%. Now, if you have been watching these markets for any length of time, you already know what those two numbers normally do to gold. A dollar above 99 and yields above 4% are the two conditions that historically compress gold the hardest. Non-yielding asset, strong dollar, textbook headwinds. And yet gold is not just holding, it is holding above $5,100. That combination, dollar up, yields up, gold still up, is the single most important signal in this market right now, and it is what this entire video is about. Last week I told you to watch the COMEX eligible to registered silver conversion rate as my one specific call. I said if conversion stalled and registered inventory kept draining without eligible metal stepping in, that would tell us the eligible holders were not motivated sellers at current prices. Here is what happened. Conversion did not accelerate in any meaningful way through the week. Registered silver continued to drain. The 62-day depletion clock I flagged did not reset. If anything, the pressure heading into the May contract cycle became more visible, not less. The setup I described is still live. I am carrying it forward, and we will come back to it. My name is John. 15 years in currency and commodity markets before I ever picked up a camera. I have watched gold go through multiple cycles. I have seen it trade as a pure inflation hedge, as a crisis asset, as a currency play, and as a geopolitical premium instrument. What I am watching right now feels different from any single one of those categories, and that is what I want to explain today. Everything I show you comes from publicly available sources, and I will name every one as we go. Today we are covering three things. First, why gold holding at $5,180 against a strong dollar and elevated yields is itself the signal, and what it tells us about who is actually buying right now. Second, what the JP Morgan $6,300 target is actually based on, because the reasoning matters more than the number. Third, the honest bull and bear cases, including what a weekend ceasefire headline could do to price on Monday morning. Let us get into it. Gold right now is at approximately $5,180 per ounce. That is below the January record of $5,602 that was hit briefly before the market corrected. It is also below the $5,123 spike that happened on February 28th, when coordinated U.S. and Israeli strikes on Iranian targets were confirmed. If you were watching that day, you saw gold move in real time on a geopolitical event in a way that was immediate and significant. Since that spike, gold has ranged between roughly $5,050 and $5,200. That range is not weakness. That is consolidation at a structurally elevated level. The central question this video answers is this. Is gold at $5,180 speculative excess that is vulnerable to a sharp correction, or is it structural support that reflects something more durable happening in institutional allocation? Because the answer to that question determines how you should be thinking about positioning right now, whether you are sitting in Ohio or Manchester. Quick question before we go further. Drop in the comments right now. When you look at gold at $5,182 with the dollar above 99, what is your instinct? Does this feel like a top to you, or does it feel like a base? I read every single one, and the comment section here becomes a genuine real-time sentiment tracker that actually informs how I approach the next video. Here is what most people are saying about gold right now. They are saying the Iran conflict is the reason, that this is a war premium, and when the conflict resolves, gold comes back down. And there is real logic to that view. Geopolitical premiums do historically compress when the trigger event fades. But here is where that analysis gets incomplete. And this is the part I want to spend time on because it changes the whole picture. When I look at where gold is trading relative to the dollar and yields right now, the number that stops me is not the gold price itself. It is the spread between where gold is and where it should be based on those two headwinds alone. In a traditional macro model, dollar at 99, 10-year at 4.15%, gold would historically trade somewhere in the $4,400 to $4,700 range. The fact that it is trading $400 to $800 above that implied level tells you something specific. It tells you the buyers at current levels are not responding to the traditional macro inputs the same way they used to. The World Gold Council noted in their February commentary that Asian physical buying during Shanghai trading hours was the specific force that held gold firm during January's dip from the record high. Think about what that means mechanically. Shanghai opens when New York is closed. The price was being supported during hours when Western paper traders were not at their desks. That is not a speculative trade. That is structural institutional demand from a different time zone, operating on a different thesis. If you know someone who has been watching gold this week and trying to separate the Iran noise from the underlying structural story, share this video with them right now. This breakdown took real time to put together, and the people who need it most are often not the ones searching for it. Now here is the thing I want to be honest about, and this is where it gets genuinely complicated. Not all of the gold price above the traditional model is structural demand. Some of it is a genuine war premium. The question is how much, and the honest answer is nobody knows precisely. What we do know is this. The February 28th strike date is documented. The spike to $5,523 is on the record. And the subsequent range of $5,050 to $5,200 tells us the market settled at a level that is higher than pre-conflict but lower than the spike. The war premium appears to be somewhere in that $100 to $200 band, above pre-conflict baseline pricing. The structural bid, the part that was already in place before February 28th, appears to be doing the heavier lifting. Here is a way to think about it. Imagine a house in a neighborhood where prices have been rising steadily for 3 years because the area is genuinely improving. Better schools, new transport links, growing employment. Then one month, a news story about a nearby development sends prices up sharply. The story fades. Prices pull back from the spike. But they do not go back to where they were before the neighborhood started improving. The structural improvement does not disappear because the news story resolved. That is roughly the dynamic playing out in gold right now. Now let me walk you through what JP Morgan and Deutsche Bank are actually basing their targets on, because this is where the analysis gets specific, and I want to give you the real reasoning rather than just the headline number. JP Morgan's year-end 2026 target of $6,300 per ounce and Deutsche Bank's $6,000 target are built on 3 pillars, and none of them is the Iran conflict specifically. The first pillar is currency debasement dynamics. When I pulled up the Congressional Budget Office's most recent fiscal projections, the deficit trajectory is not a partisan talking point. It is arithmetic. The United States is running structural deficits that require ongoing Treasury issuance at a scale that creates persistent pressure on the dollar's real value over time. I am not saying the dollar collapses. I am saying that at the institutional level, the people managing multi-decade reserve allocations are doing the math and concluding that holding an increasing percentage of reserves in gold rather than dollar-denominated paper is rational portfolio management. The Bank of England's own reserve data and LBMA vault activity in London reflect a similar directional shift in European institutional thinking, which matters directly for UK investors watching their SIPP allocations, wondering whether gold exposure makes structural sense beyond a short-term trade. These are not traders reacting to a headline. When a central bank or a sovereign wealth fund reallocates into gold, that is a decision made over months by committees. It does not get reversed on a Tuesday because of a CPI print. The second pillar is the inflation trajectory, and this is where it gets interesting in a way that most coverage is missing right now. The February CPI print came in at 2.4% year over year, according to the Bureau of Labor Statistics. That matched expectations. It did not surprise to the upside, and you would think that would be neutral to slightly negative for gold. But here is what the February number does not yet contain: the energy price impact of the Iran strikes on February 28th. CPI is backward-looking by design. The oil price surge that followed the conflict is going to show up in the March and April readings. When those numbers land, the inflation trajectory could shift in a way that reduces the Federal Reserve's flexibility to cut rates in the first half of 2026. The Fed is expected to hold rates steady at the March 18 meeting. That is consensus and not controversial. But the second half of 2026, rate path, which is where JP Morgan's bull case really lives, becomes more complicated if March and April CPI surprise to the upside because of energy. A gold that functions as an inflation hedge rather than a risk asset in that environment is a gold that institutional allocators hold or add to rather than trim. The third pillar is COMEX positioning, and this one is actually reassuring in a counterintuitive way. Here is the number that caught my attention when I pulled up the COMEX open interest data. Speculative long positioning in gold futures is elevated. No question about that. But it is not at historic extremes. This matters because when a trade gets crowded to historic extremes, the risk of a sharp positioning unwind becomes acute. Think of it like a queue at a single exit door. When everyone is trying to leave at once, the price move on the way out is violent. Gold's positioning right now tells me the queue at the exit is not yet that long. There is still dry powder, institutional allocation that has not yet been deployed, which supports the argument that the structural bid has further to run before the positioning picture becomes a genuine risk. All right, let me show you how I am actually thinking about this week using the 3 lanes framework. This is how I separate what is noise from what actually matters. The paper lane, blue. COMEX gold futures open interest is elevated but not at historic extremes, according to the most recent CFTC commitment of traders data. Speculative longs are present, but there is room for more. That is a paper market that has not yet fully priced the structural thesis institutional buyers are acting on. The physical lane, silver-colored. Shanghai gold is trading at a premium of approximately $5 to $15 above COMEX in USD equivalent terms, according to current SGE data. The World Gold Council's February commentary specifically flagged that Asian physical buying during Shanghai hours was the stabilizing force during January's dip. Physical demand is not leading the price, it is underwriting it. The macro lane, gold. DXY at 99.1 to 99.4. 10-year Treasury at 4.15%. February CPI at 2.4% with March and April readings likely to move higher as the oil shock filters through. Fed on hold March 18th with the second-half rate path now genuinely uncertain. In 15 years watching currency and commodity markets, the times I have seen institutional positioning, physical market support, and macro uncertainty align in the same direction simultaneously, even partially, have been some of the most significant periods in these markets. I am not saying all 3 lanes are perfectly aligned today. The dollar and yield headwinds in the macro lane are real, but the physical lane and the paper lane are both pointing in the same direction. And when 2 out of 3 lanes agree, while the third is creating friction rather than reversal, the historical pattern has been that the friction eventually resolves in the direction of the 2. That is a framework, not a forecast. You decide what to do with it. Here is the one thing I am personally watching this week. One thing, the Federal Reserve meeting on March 18th. Not the decision itself. The hold is expected and priced in. What I am watching is the language in Jerome Powell's press conference specifically around the inflation trajectory. If Powell acknowledges that energy-driven CPI surprises in March and April are possible, if the language shifts even slightly toward caution about the second-half rate cut timeline, that is the signal that gold's inflation hedge function gets reinforced at the institutional level. If instead Powell downplays the energy shock and maintains confident language about disinflation continuing, that removes one of the 3 pillars under the J.P. Morgan bull case, and the correction risk to $4,900 to $5,050 becomes more real. I am watching for any shift in the phrase the Fed uses around the inflation outlook. Any language more cautious than the January statement is a gold-positive signal. Unchanged or more confident language is a short-term headwind. This is my one call for the week. John, FX Insider, on record. I will be back next video to tell you exactly what Powell said and exactly how the gold price responded. No edits, no excuses. That is the only way this works. Now here is where I want to be completely straight with you, because this is where most channels pick a side and run with it. I am not doing that today. Here is what needs to happen for the optimistic picture to develop. Iran conflict persists through Q2. Oil stays elevated. March and April CPI surprise to the upside. The Fed signals a delayed or reduced rate cut path in the second half. The dollar weakens as stagflation fears mount. In that scenario, gold breaks $5,500, retests the $5,602 January record, and the path towards $6,000 and the J.P. Morgan $6,300 target by year-end becomes credible on the data rather than just on the forecast. Here is what needs to happen for the cautious picture instead. An Iran ceasefire is announced over a weekend, and today is Thursday, so that risk is live right now this week. Oil plunges. The DXY spikes above 101. Treasury yields rise above 4.5% as the growth-inflation trade-off resolves in a hawkish direction. Gold retraces to the $4,900 to $5,050 support zone. J.P. Morgan and Deutsche Bank revise their targets lower. In that scenario, the structural thesis is not wrong. The debasement dynamics and central bank demand do not disappear, but the timeline extends and the near-term entry point risk was real. Both are genuinely possible right now. The weekend gap risk alone, a ceasefire headline producing a $100 to $200 Monday gap down, is not a tail risk this week. It is a live scenario. Your job is not to pick one outcome and emotionally commit to it. Your job is to watch which conditions are actually developing. The market will tell you. You just have to be watching the right things when it does. Before we close, the disclaimer you need to hear, and I mean it. Everything in this video is educational content based on publicly available information. Currency Insider does not provide financial advice, investment advice, tax advice, or legal advice. Nothing here should be construed as a recommendation to buy, sell, or hold any asset. Past market behavior is not a guarantee of future results. Always consult a qualified financial professional before making investment decisions. Before the two questions, if you got value from this today, the like button takes 1 second, and it genuinely helps this channel reach people who are trying to navigate these markets without all the noise. Hit it now. I want to ask you two things, and I genuinely want your answers, not just a thumbs up. First, are you currently holding gold, adding to your position, or sitting on the sidelines waiting for a clearer entry point? Tell me where you actually are right now. Second, of the three pillars behind the JP Morgan $6,300 target, debasement dynamics, the inflation trajectory, and COMEX positioning, which one do you think is doing the most work? Drop both answers below. The comment section here becomes a real-time sentiment tracker, and I read every single one. Subscribe, because next week we are going into the Federal Reserve March 18th meeting in detail, specifically how to read the post-meeting language for gold signals rather than just the rate decision headline. And that is a skill worth having in the weeks ahead. And if someone in your life is watching their gold position right now and feeling uncertain about whether $5,180 is a top or a base, share this with them. That is the whole point of this channel. This is Currency Insider. Know the market. Protect your currency.